Hello, ladies and gentlemen. My name is Robert Campbell. I am the author of the book Timing the Real Estate Market that I published in 2002. I am also the publisher of the Campbell Real Estate Timing Letter. That is a real estate timing newsletter that covers 19 major cities in the United States, 5 of which are in California: San Francisco, Los Angeles, San Diego, San Jose, Santa Clara, and Sacramento. For those of you that don't know me, let me just give you a little bit of background about myself. I have a degree in economics from UCLA. I graduated in 1969, and also I have an MBA in finance. More importantly, with respect to real estate, I'm the son of a home builder, and I've been around real estate my entire life. My dad was a builder-developer for 50 years, and so I am infinitely familiar with the ups and downs of the real estate cycles. In today's webinar, I want to do 2 things, ladies and gentlemen. I want to educate you, I'm going to scare you, and I'm going to motivate you. Starting with one of my favorite slides is on slides 2 is from Charles Darwin. Survival of the fittest, adapt or die. It is not the strongest of the species that survives, nor the most intelligent. It is the one that is most adaptable to change. And I love that because that's what allows you to be successful in life, is adapting to change. And if you look back, going to the next slide, if you look back at the Fortune 500 companies back in 1955 versus 2015, only 12% of those companies are still on that list, ladies and gentlemen. That means the other 88% have either gone out of business, their business has contracted so that they're no longer on that list, or that have been purchased by other companies. So yes, survival of the fittest is what it's all about. Where the U.S. housing market is going and why. The Case-Shiller 20-City Index was up 5.7% year over year in January 2016. That was the same year-over-year reading as the previous month. As you can see by looking at the momentum chart there at Case-Shiller, that momentum started to fall at the start of 2014, hit a bottom at the start of 2015, and has been increasing. That has been gaining strength ever since that time. What that means is that the U.S. housing market has continued to gain strength, is gaining strength right now as opposed to losing strength. It's important to understand that when it comes to tracking real estate trends, the only thing you should be following is year-over-year data. Don't listen to month over month or, quarter over quarter for that matter, because that tends to be noise. And I know that, the newspapers like to quote year over year data and short-term data like that, because when it's either good or bad, it makes for good headlines, and sells newspapers. But when it comes to timing real estate markets, that's something that you should not be concerned with. Only look at year over year data. The trend is still up, as shown in this chart right here. Real estate is a very, very cyclical business. It always has been, and it goes from very good times to very bad times, and now we are in a upward trend that is very good for real estate investors and owners. As I mentioned previously, U.S. home prices accelerated year over year at the start of 2015, as shown in the next chart I'm looking at, the bar chart. As you can see there, the Case-Shiller index, the 20-City index went from a reading of 173.44 up to 182.33 in a period of 7 months. Very, very rapid rise in home prices, and that's is what caused the momentum chart to start curling back upwards, so it's gaining more strength than it's losing strength. Since that time, however, you've seen since about August 2015 through today that it's been in a fairly tight range. You know, it hasn't gone up or it hasn't gone down. So I do expect that momentum chart probably in the next 2 or 3 months, if nothing changes, if interest rates don't keep going down, that momentum chart will start to fall off and could start returning back toward the zero line, which is the point at which you should be. You know, that would signal a trend change. Next chart. All Case-Shiller cities are up year over year. All 20 of them. Leading the pack is Phoenix. That's up almost 12%. Then you see, you know, in double digits, you see Denver, you see San Francisco, and you also see Seattle. And Dallas isn't too far behind either. So, and the weakest of all the Case-Shiller cities is Chicago. It's at 2.2% year over year. And it's my feeling, not only because of this chart that you're looking at right now that shows the year-over-year changes, but Chicago is in a deep hole with respect to pension liabilities, especially for policemen, firemen, and some other government employees. And there's something like only 25 to 30% funded. And Mayor Rahm Emanuel is increasing taxes like crazy to try to cover up that shortfall so that the government workers get paid their generous commissions. Well, what's happening right now is thousands and thousands of rich people are voting with their feet and they're leaving Chicago. Of course, I anticipate this will put a surplus of properties on the market that will drive properties down, and I fully expect Chicago to be the first city to take a fall during this bull market. Next slide. Even though the Case-Shiller 20-city index has risen very nicely since the bottom in March of 2012, please understand it is still 11.6% below its March 2006 peak reading. The FHFA index, however, is now at all-time record highs. And that's shown by the red line here on the chart, and the blue line here on the chart is the Case-Shiller 20-city index. So that shows you, even after this recovery in housing prices nationally, home prices are still down close to 12%. Now that varies city by city, as I will show you now. You know, some cities, I believe that there are three cities, Boston, Dallas, Denver, and Portland, are now at record highs. All-time record highs. And if you notice that those cities there weren't big participants during the real estate bubble, they didn't go up like a moonshot and come down like a F-18 fighter plane that just lost all power. So even and since that rise, you know, since the bottom of the market in 2012, I believe it is Phoenix has gone up something like 60%. You know, if you look at this chart over here on the far right-hand corner, it is still 31% below its peak reading back in 2006. With respect to those other cities that are still deep in the hole, Las Vegas is down 38%, even though that's been a sterling performer, you know, during this real estate recovery. And Miami's down 27%. What that goes to show you, ladies and gentlemen, is what goes up the most and the fastest is most likely going to go down the most and the fastest, because things do return to normal, not only in life, but also real estate markets. So that's why timing is really, really critical, especially in California, as I'm going to be showing you. In a few minutes. On a national basis, looking at real estate on a national basis, I would now like to look at all the trend indicators that I follow and see why the trend is still up. If you read my book, Timing the Real Estate Market, I present 5 key indicators that if you follow them on a year-over-year basis, they will tell you when the trends, not only for the national real estate market, is turning from up to down and down to up, but also any local city. Those 5 key indicators are as follows, and I'm going to repeat them again as I go over the why the trend is up both nationally, locally, and a few other markets. But the 5 key indicators are as follows. 1, existing home sales. 2, new home building permits. 3, notice of defaults. 4, foreclosure sales. And 5, interest rates. So if you follow those 5 key indicators and track them on a year-over-year basis, going back in time, and notice when the trend changes in each of those indicators, when the weight of the evidence becomes so overwhelming that they're all in negative trends, or 3 out of 5 of them, I should say, are negative trends, that means that there's about a 95% confidence factor that we are going to have a trend reversal. So let's look at based on those 5 key indicators. Let's look now at why the trend for national real estate is up. Vital sign indicator number 1, existing home sales. They were up 2.2% in Feb 2016 compared to Feb 2015. Again, we're looking at year-over-year data. I'm showing you this chart here right now because the red line shows existing home sales, ladies and gentlemen, existing home sales, and the blue line above it shows the Case-Shiller National Home Price Index. And as you can see, the correlation between those 2 lines is extremely high. It probably has a 90% correlation. In other words, when existing home sales are going up, prices are going up. When existing home sales are going down, prices are likely to go down. It's real simple to explain. It's all about supply and demand. When there's high demand, it's pushing prices higher. When demand falls off, prices tend to fall lower. So there's our first key indicator, and that supports rising prices, which we're seeing right now nationally. Supply of homes for sale was 4.4 months in Feb 2016, down from 4.6 months in February 2015. This isn't a key indicator that I frankly knew about at the time I wrote my book in 2002, but I have since, in the last 14 years, I've probably increased my level of knowledge with respect to real estate timing by at least 100% and maybe 200%. And this is one of the key indicators that I found that is really, really great for market watchers to follow if you want to time real estate markets. The key line here is 6 months supply. If you look at that blue line that's measuring the months of supply of homes for sale, which I should explain a little further, what that means is you take the total number of homes that are being sold in any given month, and you divide them by the number of homes on the market. At any point in time, if that number is greater than 6 months supply on the market, what that means is that it is a buyer's market, and that there's falling demand, there's more inventory on the market, and prices are more likely to fall than they are to rise. And when that number of months of homes on the market is below 6, that means it is a seller's market, where the sellers are in command of the market, and prices are likely to rise. So if you look at that blue chart there that goes back to about 1999, you can see through 2000, 2002, 2004, and even through most of 2000 up to 2006, that line was below 6, and that means that housing prices were more likely to rise, which they did rise. That was during the bubble period. All of a sudden, it rose up above 6 months supply, and that was a period of the time when the bubble burst, of course, and prices started crashing. And so they stayed above 6 all the time until right around, April, maybe May of 2012, even though my other timing indicators got you in a couple of months earlier. As you can see, then it fell below the 6-month supply line, which signaled that it was a bull market in stocks, and they've remained in the real estate market, and housing prices have been rising ever since. So that's a very, very good indicator to follow. Next slide. Vital sign indicator number 2, new home building permits. They were up 7.2% year over year in February 2016. So again, that is building permits are up for the simple reason that demand is up. And when people are buying new homes, builders respond to that call by pulling more permits and building new homes. And when that trend is down, that means there's no demand. Builders won't, of course, keep building new homes that they can't sell, so permits will fall. So if you look at the peak of the market back there starting in about 2006, look how that line fell off. Permits, so it was a good leading indicator to a coming trend change in the real estate market. Next slide. Vital sign indicator number 3, mortgage defaults. They are still trending lower on a national basis, and in fact, they are near pre-crisis labels. In fact, if we go to vital sign indicator number 3 again, looking at mortgage defaults on a more current chart, you can see they are still in a downtrend. It's still in a downtrend with the blue vertical bars. However, I'd like to caution you about one thing as you look at this chart. You can see that they are, the height of the bar in the year 2015 is pretty close to the same height of the bars in 2002, 2003, 2004, 2005, when real estate was in a bull market. So I'm watching this key indicator very, very closely, because when those notice of default start ticking higher, that means a trend change is surely coming. And I promise you, ladies and gentlemen, that the notice of defaults, that line isn't going to keep dropping to zero. That's just not the way the world works. So it looks like it's back to normal levels right now, and the next major move from here isn't going to be down lower and lower and lower. It's going to be higher, and that's what, of course, will be when the market turns and real estate prices will start falling, or in some places crashing again. Vital sign indicator number 3. Next slide. Mortgage rates. Mortgage rates are at about 3.79% right now, and they're still only 5 percentage points above their 2013 all-time record lows. So interest rates are very, 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 very favorable for home appreciation at this point in time. Now let's look at California's real estate market. The boom-bust cycles in California are the most dramatic in the country, ladies and gentlemen. It therefore should come as no surprise that the slowdown in price appreciation will be most amplified in California during the downturns, and it will be most amplified during the upturns. Take a look at this chart here that really, really tells the story. The red line is housing prices in California, represents that on a statewide basis, and the blue line represents U.S. housing prices in the United States, and that index is from FHFA. As you can see, the chart starts at 1975. As you can see, nationally, up until the year 2006, actually 2007, U.S. housing prices had never once, ladies and gentlemen, had a year-over-year price decline. However, if you look at California, that wasn't the case. In California, back in the early 1990s, we had the start of a bust, and real estate prices went down for 6 straight years. Then the rise started, and real estate, the prices went near vertical during the bubble years, and then came crashing down. But what this shows you is this. If you invest or speculate in real estate in California, real estate timing is more important than any other state in the country. You can make more money in California than you can anywhere else, and you can also lose money compared to any other state in the country if you're on the wrong side of the trends. So even in the long term, while California housing prices have appreciated at a faster pace annually than in other parts of the country, this is the perfect place for market timing, folks. Perfect place. Because if you catch the start of an upturn and ride it to the peak and sell at the peak, you can make a ton of money. Then sell, pay your taxes, wait for the next market downturn, and do it over again. Buy at the market cycle bottom and watch watch your equity and your wealth grow. Next slide. The home price index for California, this is all FHFA index. Number one, prices fell 40.6% from the 2002 peak. This is giving you some statistics to show you how volatile the California housing market is. Two, housing prices have risen 43.1% during the recovery. Yet they're still 15.1% below the 2006 peak. So if you were unlucky enough to purchase real estate in California in 2000, 2005, 2006, even 2007, and even after prices started coming down, even after this giant recovery we've had, since market hit bottom in March of 2012, you are still 15% underwater on your home value, ladies and gentlemen. That's why timing matters, especially in California real estate. Let's look at the home price index for San Diego, FHFA. Prices fell 34.9% from the 06 peak. They have since risen 37% during the recovery. Yet they are still 10.8% below the 2006 peak values. So that shows you that just like the state, San Diego is also almost 11% below peak values, even after this real estate boom that took prices up 37%. Interestingly, here in California, there's not many areas where housing prices have reached new highs. San Jose and Santa Clara is an exception to the rule. Prices fell only 26% from the 06 peak, have since risen 56% during the recovery. Yet they are still 14.1% above the 2006 peak value. So this has been the best performing real estate area in California, and in California, and it's all because of Silicon Valley. You have your Google, you have your Facebook, your super high-paying jobs down there, and it has just pushed real estate values to incredible heights down there. Okay, now I'm going to look at the 5 key vital sign indicators for California right now. Vital sign indicator number 1, California existing home sales. They're up 6.4% year over year in February 2016. Yep, that means that key indicator, the trend is up, and that's supporting higher prices. Vital sign indicator number 2 for California, new home building permits. They're up 20.6% year over year in February 2016. Another good sign supporting higher prices down the road. Vital sign indicator number 3, mortgage defaults for California. They're down 13.4% year over year in January 16. Again, that's the kind of trend that we want to see that supports higher values and not lower values in the coming months and years ahead, perhaps. And here's another vital sign indicator number 3, mortgage payments, as shown by 90-day or more delinquencies. They're down 23.1% year over year in the second quarter of 2015. That was the lowest total since 2007. And as you can see by that chart, that line is still falling. And I expect that line to still fall until it gets back to somewhere around the normal line, somewhere probably around 0.75%, somewhere around there. This chart's a little dated, so we may be down a little bit lower there right now, but you can see how we're getting back to normal right now. That chart is returning back to normal. State of the U.S. economy. This is one of my favorite subjects. If you invest in real estate, you have to understand the U.S. economy. The 2010 decade so far has been the slowest decade of GDP growth since the Great Depression of the 1930s, everyone. The slowest, as shown by that red bar. Due to no emergency savings, approximately 62% of all Americans said they cannot even cover a $500 unexpected car repair bill if one came up. I'm showing you this slide to show you how close the average American is living next to the edge of the cliff, where it would be absolute disaster if he lost his job. The federal debt has doubled in the last 8 years. Doubled. That President Obama, even though I am not a Democrat nor a Republican, I hate both criminal families, that you can see that during that period of time, national debt is going vertical. In the last 8 years, the national debt has increased by a greater amount than it has ever increased, than the total amount that it increased during the entire history of the United States. That shows you that what kind of crisis we're now in, where any kind of recovery, any kind of economic growth is all being stimulated by debt, ladies and gentlemen. Purely debt, as opposed to entrepreneurial actions, profits, savings, capital accumulation. It's not. It's all debt. So that you wonder, going back to that slide, you wonder, why hasn't the U.S. economy crashed? Because debt is rising like it is? Simple. Interest rates have been in a downtrend for the last 35 years. What that means is this, that, and I'll just make a simple example of it. Let's say you could borrow $1 million in 1980, and it would cost you 15% interest. That means, and you could afford to pay the interest, so you borrow $1 million. Cost you $150,000 worth of interest per year. Interest rates fall from 15 to 7.5%. You don't have the money to pay off the loan, of course. So what you can do, however, is that when the loan becomes due, you can not only refinance at 7.5, and make your payments. Your payments would only be $750,000 or $75,000 a year. But what the hell? You can borrow another $1 million and keep your payments at $150,000 a year. So you borrow $2 million. Then interest rates drop to 3.7%, and you can again, when the notes become due, that you don't pay them off because you don't have the money. What you do is you just increase your borrowing from $2 million to $4 million. At the lower interest rate, your payment stays the same, $150,000 a year. And then if you want to take your interest rates even lower, like they've been recently during the Fed policy of 0% interest rate policy, heck, you can take them down to 1%, 0.5%, and borrow $10 million and still keep your interest payments the same. So lower interest rates, to a large degree, is what has saved the U.S. economy from a debt disaster, folks. And this chart shows it very well. The orange line shows the 10-year Treasury rate on the 10-year note, how it's been declining since 1980, and look how the national debt has gone up. So in other words, the lower the interest rates go, the more and more debt that the U.S. government and even individuals can accumulate and keep their debt servicing payments the same. That's what's keeping the U.S. economy afloat right now. If that trend should turn and interest rates start going back to normal levels, it's going to be an unqualified disaster. What about the U.S. job market? Like the U.S. economy, it's also weak. The U.S. labor participation rate, that's what this chart shows right here, that was 62.6% in July 2015, the lowest it's been since March 2018. And what that means, folks, is that working-age Americans, which are considered people to be from the ages of 16 to 64, anybody that's in that age is considering a working-class age, that only 62% of those people have jobs. Whereas back at the peak of the market in the 2000, that 67% of those people had jobs. And that, when you bring this chart up to people and say, gee, the reason this participation rate is declining the way it is, it's for the simple reason that baby boomers like myself are going into retirement, or some even into early retirement. Well, let's look at the next slide and see how true that is. This chart here shows, starting in the year 2007, the red line shows the number of working-aged Americans between 55 and 69 years old, what that workforce has done. And you can see it's increased by approximately 5 million workers. Then let's look at the workers aged 16 to 55. What's happened to those? Those are that other element of that group. they've declined. They've declined by almost 2 million jobs during that period of time. So therefore, it's the older people that are still continuing to work. They have to work, ladies and gentlemen. They have to work because the cost of living keeps going up, at 1 or 2 or 3%, every year, how you measure it. And incomes during the last 10, 15 years have been flat to down. That's why older people are working, and that's why the U.S. economy with respect to jobs is in real bad shape. Middle-class Americans are worth less today than they were in 1969, adjusted for inflation. You consider there was peak net worth for that median net worth was in 2007, which was $115,000. $115,000 per household. Not surprisingly, that coincides exactly with the peak of the housing bubble. In other words, everybody's net worth just, rose because the value of their houses was rising. That as we look back, however, that wealth wasn't real. It wasn't real at all. That was during the time of easy and cheap money, where as long as you could fog a mirror and you didn't have to have any a job, really, you could lie about that. You didn't have to have a down payment. You could get away with that. That you could tell them you were earning any kind of income you said you were earning, and you could even have a crappy credit report, and it didn't matter. You could buy a piece of real estate, with no money down, and that's what drove housing prices upwards. Afterwards, when the crash came, you could see that those net worth numbers almost got cut in half. Question: if the U.S. economy and its job market are in such bad shape, why are the U.S. housing prices rising? It's because mortgage rates have fallen, folks, from 8.3% in the year 2000 to 4.0% where they are today, as you can see by this chart right here. That falling mortgage rates explain why U.S. housing prices are up 70% since the year 2000. In other words, that for every percentage point that a mortgage rate falls, that increases the purchasing power of a home buyer by almost 11%. So if you multiply 11% by 4.5% percentage point drop in mortgage rates, that comes out to what, 44, almost 50%. 50% of that 70% rise, ladies and gentlemen, that we've seen since the year 1970, since the year 2000, can be explained by falling interest rates and nothing else. That's one of the reasons why the Federal Reserve, is keen on keeping interest rates lower, and they may almost be desperate to keep interest rates lower, because they know if these things ever return to anything close to normal, like and the normal interest rates over the course of the last 50 years have been somewhere around 7 or 8%. But if interest rates were to rise from where they are today, which is right around 3.5%, back to let's say 7.5%. Housing, that's a 4 percentage point fall. Housing prices across the United States, ladies and gentlemen, would fall by 45%. And that's the only way that they wouldn't fall by 45% is if incomes were to take up some of that slack, and I don't see that happening with the outsourcing of jobs. So interest rate is a real key indicator to follow during this bull market in real estate. Next slide. Let's look at Los Angeles. I want to explain, that how housing prices have been rising and incomes have been falling. Los Angeles. Here you see the blue, the white line shows the Case-Shiller Home Price Index for Los Angeles, how it's been, rising up, nicely since they hit bottom in early 2015. But look what's happened to incomes, which is that yellow dotted line. They're falling. Trust me, this is not sustainable. Let's look at Denver. Same situation. Case-Shiller Home Price Index rising very nicely. The yellow dotted line, household incomes falling. Phoenix, same situation. Home prices up, incomes down. This is not a sustainable situation, ladies and gentlemen. With falling incomes, if interest rates ever start going up, it's going to be an absolute disaster for housing prices. It's going to mark the peak of this boom or bubble, which however it ultimately gets classified, and that's going to be the time that if you are risk adverse, you're going to want to sell your real estate, take your profits and wait for the downturn to get over to buy back in again. So same with Phoenix there. Putting all these economic facts together, what does it mean? Rising asset prices are like a circus mirror. It creates the illusion of prosperity. Rising asset prices, which includes real estate, are like a circus mirror. It includes the illusion of prosperity that deludes us into believing that anything of economic value has been created by the Fed's manipulations and that we are wealthier than we actually are. Just like in the year 2007, the median household net worth was $115,000. Everybody thought, that's the highest it's ever been in U.S. history. Everybody thought that they were doing really well. We're doing quite wealthy. After the crash, it fell to $64,000. In other words, that $115,000 net worth figure was an illusion, folks. It was an illusion. It wasn't real. And these values that we're seeing today in the housing markets that are totally dependent on falling interest rates, they're not real either. Robert Campbell's outlook for housing prices. How I evaluate market conditions. In God we trust, all others bring data. That's all I listen to, ladies and gentlemen. I follow key data, and I found out during all my years in real estate, anything that I've done, the people that follow the data, use data to evaluate markets, analyze what the trends are, do infinitely better than those who don't use data. So I'm all about data. My real estate crash index as of January 31st, 2016 for Southern California. This is the crash index that I show in my book, Timing the Real Estate Market. And what it is if you take those 5 key real estate indicators that I've been talking about, remember, existing home sales, notice of defaults, new home building permits, foreclosure sales, and interest rates, if you put them all together, and weight them a certain way, and that's my secret, how I weight them, but you could play around with it and come out with your own weighting structure. If you mess around with that, and what this does is anytime that momentum line, that dark line there, falls below zero, that means the zero line, that means prices are more likely to fall than they are rise, and when it's above zero, just the opposite, housing prices in Southern California are more likely to rise than they are fall. As you can see here, my crash index for Southern California gave a sell signal in August 2005. It gave a buy signal, so it kept you out of the market for 3.5 years. Then it gave a buy signal in April 2010. And because the line is still at plus 14, which is 14 points above the zero line, we are still on a buy signal. So in other words, I've had that my real estate crash index has had you long Southern California real estate for almost 6 straight years now. Buy and hold 6 straight years. And how accurate has that timing indicator been? Let's look at the Case-Shiller's Home Price Index for San Diego, which I'm showing you there from 1997 through the year May 2015. The buy signal was given in December 1996. Great time to be buying real estate. Prices went up, up, up. Gave you my crash index gave you a sell signal August 2005, which was about a month or two away from the peak prices. So that too was a great signal, and it gave you a buy signal back in after the fall. Told you to buy back in April 2010, and as you can see, prices drifted a little lower. In the next 9 months, not much, but all in all, that's been a terrific time. That was a terrific time to buy, and we're still on that buy signal today. If I had to identify one major city in the United States that's in the bubble mode right now and is almost certain to crash, that would be San Francisco, as per this slide. That the median home price, and we're talking San Francisco in the city, not the Bay Area that includes the peninsula or East Bay or up in the wine country. Just this is the city, San Francisco. Housing prices were hit $1.2 million. That was the median price in Q4 2015. That was up 88% from the first quarter of 2012. And look at that price rise, folks. Nearly vertical for, 1, 2, 3, 3.5 years. that bubble's going to pop, folks. That bubble's going to pop. I can almost guarantee you that bubble's going to pop. I've never seen a price chart like that hold on. Something's going to happen in the Bay Area. The technology business down in Silicon Valley, San Jose, Santa Clara, that's going to take a hit somehow, and it's going to take San Francisco City down with it. So you compare San Francisco against the yellow line on that chart right there. That's for California. So you can see, even though California is more volatile than the United States, which is reflected in the red lines with the triangles on them, San Francisco has just been the most profitable place to own real estate in the United States that I'm aware of in the last 20 or 30 years. And now it's just going gangbusters, and it too is going to fall. It too is going to probably come crashing back down to earth at some point in the future. So I'd be really, really careful and watch your timing very, very closely if you own real estate up in the Bay Area, folks. San Francisco, same situation. Remember the charts I was showing you about Los Angeles and Denver and Phoenix? Here's one in San Francisco. The blue line is showing you Case-Shiller. Prices are going up. The yellow dotted line is median family household income. It has since fallen off and going down. But also I'd like you to take a look at that blue dotted line there, which is the rent index. Rents in San Francisco are going absolutely crazy. A one-bedroom apartment rents on average for around $4,000 a month. A two-bedroom rents for $5,000. I mean, just talking rent alone, that for a two-bedroom place, that is $60,000 a year. $60,000 a year just in rent. That is almost as much as the median household income of the entire United States. That's for all the income. So the average household in the United States couldn't even hardly afford 1 month's rent in San Francisco, and if we were looking at after-tax dollars, it wouldn't even be close. But so that's the state of the San Francisco housing market right there. Be real careful about that. Commercial real estate. Does this look like a bubble to you? Looks like a bubble to me. Look at this. Look at that price line. Look where the index is. The old index high back in September 2007 was 100. We're at 119 of August of last year, 2015. I'm certain that we're even above that right now. In other words, the commercial index real estate is 20% above the old highs. And so why is it performing like that? It's for the simple reason that institutional money right now, you can't get any yield on it. That institutional money, that you look at short-term interest rates. Short-term interest rates right now are at near zero. And so to get any kind of a yield whatsoever on your money, that commercially and for pensions and things like that, they're jumping into the commercial market. And in California, San Francisco, they're buying property at 2 and 3% cap values, cap rates, which are amazing. Nationally, they're even higher, but a lot of that money is just flooding into the commercial market looking for yields. That too there is a bubble looking for a pin. Market alert. This timing indicator says a downturn in housing is looming. This is something that I just discovered about 6 months ago, and I think it's really, really great. Looking at the top chart there, that black line, what that black line is, that's the median sales price of new homes in the United States adjusted for inflation. The red line above it is the median line of wages and salaries that have been adjusted for inflation. And so it goes back to about 1960, and you can see every time that the black line, which means house prices have gone above, have risen higher than incomes, a real estate downturn is coming. Like you look at it in 1980, that black line came back through the red line in 1980, and that signaled the start of a market crash. In 1990, the same thing, and I've circled these on the chart. 1990, you see in the incomes, the housing price, new home housing prices were higher than incomes. Then it came crashing back through to the downside. That signaled the downturn, the start of the downturn. Back during the bubble, same situation. New home prices had risen too high, too fast, and higher than incomes, came crashing through about 2008. And that signaled a downturn in prices. And to show you how accurate that indicator is, I took the 125-year chart that Yale economist Robert Shiller has put together of existing home prices in the United States that have been adjusted for inflation. So if you go back up that first sell signal at 1980, you can see where that sell signal occurred. I indicated it with an arrow there. That was almost the exact peak of the national housing market, ladies and gentlemen. The next peak occurred in 1990. Look at the second arrow on that lower chart. Again, nailed the peak of the market almost perfectly. Then the peak during the bubble that occurred in 2008, that was that almost too nailed the absolute high for the national housing market peak values. What I anticipate is looking at that fourth circled area over to the right on the chart, that the line for existing graph line for new home prices is still above the red line for incomes, but when that comes crashing back through that line to return back to normal, that there's a very, very good chance that too is going to signal peak housing prices for the U.S., that the bull market is over, and now that we're in the bear market. And the next bear market in the United States, I anticipate that's going to take housing prices, real housing prices, down, which means adjusted for inflation, approximately 15 to 20%. If you throw inflation in there, it's probably going to be anywhere between 20 and 25%. And just an educated guess, I would put California, the next downturn in California, I would add 10 percentage points to the national numbers, because as I showed you before, that the booms and busts are more exaggerated. I would guess that California housing prices are going to drop anywhere in the range between 30 and 40%. So watch the timing, folks. Okay, driven by the next chart, driven by the Fed's manipulations of interest rates, this is another artificial housing boom, ladies and gentlemen. Just like the 2002, 2006 boom, we already know how this one's going to end. The state of the U.S. economy, I'd like to revisit that. I'm going to show you the bigger picture, what I call the 8,000-pound gorilla in the room. And simple math shows how America is headed for an economic disaster. For the simple reason is this. The total debt on the books right now, if you look at this chart right now, this shows you, even though it's a little inaccurate, it was done back in 2012. The total debt, national debt back in 2012 was around $11 trillion. But if you look back in 2000, that if you add all of the true liabilities that the U.S. is on the hook for, and that includes Social Security promises, Medicare promises, Medicaid promises, and the promises that they've made to government workers for their pensions going forward, that hole that we're in isn't $11 trillion, it is $211 trillion. So this $211 trillion fiscal gap, in other words, is 16 times larger than the official U.S. debt, which shows you that the $19 trillion of debt only represents about 6% of the true financial problems we face as Americans. That mountain of national debt is literally only the tip of the iceberg. What's needed to fix this $211 trillion fiscal gap, you ask? We have two options. Because it's pure mathematics. It's pure mathematics. There's no way around it. Option number one would be an immediate and permanent 58% increase in federal taxes. If we increase federal taxes right now by 58% permanently, forever, we don't have a problem anymore. with respect to meeting the government's requirements, to meeting its obligations that it's promised. Of course, increasing 58% income taxes by 58%, of course, would send the U.S. economy into a depression, probably twice as bad as the 1930s. But nevertheless, I have to show you. I'm showing you this only to show you how bad the problem is. We do have another option. Let's say we don't want to raise taxes. We can go with option number 2, which would be an immediate and permanent 36% spending cut in benefits / entitlements, ladies and gentlemen. That means the government workers, the government pensions would get slashed by 38%. Social Security would get permanently and immediately slashed by 38%. Medicare would get permanently and immediately slashed by 38%. And it's not hard to imagine what would happen if that was the case. Once again, we would go into an economic downturn in the United States like we've never seen historically. That's how bad the problem is, ladies and gentlemen. So this means 2 things. It means 1, an economic storm will come, and 2, you should have a strategy to protect your asset when that time arrives. It means that the fiscal shortfall of $211 trillion is so massive that the politicians will not even try to save you. They won't even try to save you because it's unfixable. The problem's unfixable. And if you follow TV, and you follow CNBC, which I call the entertainment financial channel, there's some people that are starting to come on TV, some truth tellers nowadays, and telling you the problem is unfixable. It's unfixable. So in other words, you have to start preparing yourself for the fall that's going to come, the downturn in the American standard of living, and try to protect your wealth as best you can so that you will survive the fall better than others. And by downfall, if you somehow just happen to hang on to everything that you have right now by being in the right asset classes in the right time, and everybody falls off 75%, you're the winner by default, ladies and gentlemen. You may not have any more money, but you're the one that has the biggest pile relative to everybody else. So that they're going to keep kicking that can down the road until it falls off, and then it's up to you doing that, while they're kicking the can, to make sure that you've got your money invested properly. As investors know this, Fed manipulation to lower interest rates and boost the housing markets isn't magic. It's a trick. So what should you do with your money? You got option number 1. Try to guess on your own what's going to happen in the future, or listen to the intelligent-sounding commentators that are guessing too. Or, and this is the strategy and option that I prefer and that I follow trends and let the markets tell you, 1, when to act, and 2, where you should be investing your money. My predictions for 2016, it's going to be the year when we start to see who's prepared for bad economic times and who isn't. Or as Warren Buffett says, only when the tide goes out do you discover who's been swimming naked, ladies and gentlemen. When the tide goes out, you're going to see who has a strategy and is prepared for the falling tide and who isn't, and who's standing naked. This is one of my favorite sayings, and it's from Lou Holtz. Life is 10% what happens to you and 90% how you respond to it. You have a lot more control than you think you do in what happens to you in this world, ladies and gentlemen. You may not be able to control what happens to the world, but you can control how you respond to what's happening in the world, and that's going to make all the difference. Thank you very much. That ends this presentation for tonight. For this afternoon, I'm sorry. And a 30-second commercial to add. Anybody that's listening to this webinar and that would like to buy my book, Timing the Real Estate Market, for $35, I will give you a free copy of my March 15th, 2016 timing letter, which has a value of which I sell for $30. But I'll include that free if you buy a book. Or if you want to subscribe to my the Campbell Real Estate Timing Letter for 1 year, and that's $135, I'll also give you the book for free, and I'll give you I'll add 2 free issues to your subscription. So as opposed to getting 6 issues during the year, because I publish once every 2 months, you will get 8. So that means I'm giving you an extra $60 of value. I am now open to take questions, and I am happy to do that. So we'll take it from here. Thank you.